Welcome to this explainer. Today, we're breaking down a truly fascinating source analysis that's, quite frankly, going to challenge everything you're hearing about the stock market right now. We're looking at a really compelling argument that suggests this current artificial intelligence IPO boom, what everyone is calling the greatest technological opportunity in history, might actually be a massive, perfectly disguised market trap.
Okay, let's dive into this. The source material hits us with a huge paradox right out of the gate. Think about it for a second. Every single time you buy a stock, someone on the other end of that transaction is actively choosing to sell it to you. And an open door in finance is almost never just an act of generosity. So if these AI companies are supposedly going to define the next 100 years of human progress, why are the people who built them so incredibly eager to hand their shares over to you in exchange for your cash?
To really get this, we've got to look at the mechanics of an initial public offering, or IPO. When you strip away all the celebratory headlines and the ringing of the Wall Street bell, an IPO is fundamentally a trade built on massive information asymmetry. On one side, you have the informed sellers. We're talking founders, early employees, venture capitalists. These are the people who have seen the raw numbers. They know the company's deepest secrets. And on the exact opposite side, you have the uninformed buyers, everyday retail investors who only get to see the polished marketing pitch. The insiders are making a highly calculated decision here. They're deciding they would rather have your money than hold on to their own equity.
Which brings us to this really cool concept, the market tell. Just like in a high-stakes game of poker where a player might have this tiny unconscious physical tick that totally gives away their bluff, financial markets have tells too. But these tells don't come from glowing press releases or pundits yelling on cable news. A market tell is revealed by watching what financial professionals actually do with their own money. Because while average investors might panic sell when the news is bad, the smart money usually does the exact opposite.
And that brings us to a classic piece of wisdom from Benjamin Graham. He's the father of value investing, and the guy who actually mentored Warren Buffett. He famously said, and this is absolutely crucial, the intelligent investor is a realist who sells to optimists and buys from pessimists. The analysis uses this exact quote to highlight a truth we see over and over in history. Insiders notoriously sell when the hype and the optimism are at their absolute loudest. They cash out when the story is everywhere, and there is a huge line of optimists begging to buy in, because that is the exact moment they can extract the maximum amount of cash for their shares.
Let's see how this builds into what the source cleverly calls the dine and dash cycle. Now, this isn't some new phenomenon. It's a historical pattern that shows up right before almost every major financial bubble bursts. We saw it in 1999 during the dot-com bubble. We saw it again in 2007, right before the global financial crisis. And we saw it most recently in 2021 with the SPAC craze. The pattern is literally always the same. The markets boom, insiders rush to sell their shares to the public, and then bam, they dash for the exit right before the bill comes due. Let's look at a very specific example from the analysis to see how this plays out in the real world. Flashback to June of 2007. Wall Street is completely red hot. The founders of Blackstone, Stephen Schwarzman and Peter Peterson, decide it is the absolute perfect time to take their massive alternative asset manager public. Between the two of them, they walk away with roughly $2.6 billion in cash. Just a little over a year later, the global financial crisis strikes and Blackstone's stock plummets by about 90%. Those insiders timed their massive cash exit perfectly, leaving retail investors completely holding the bag.
The really crucial point here is that this happens over and over. Look back at the dot-com bubble in 1999. You had this record concentration of tech companies going public. Insiders got super rich, everyday retail investors thought they were buying into the digital future, and then, poof, $5 trillion in market value just simply evaporated. A study by the Kauffman Foundation and Professor Jay Ritter found that 10 years after going public in that era, only 29% of those emerging growth tech companies were still standing. Think about that for a second. 71% of the so-called digital future just vanished into thin air.
Fast forward to 2021, and this exact same market tell showed up again, just wearing a slightly different costume. The SPAC, or Special Purpose Acquisition Company. These were essentially blank check shell companies that let private businesses go public without all the traditional scrutiny. In 2021 alone, 613 SPACs raised over $160 billion. But man, once the rug was pulled, the whole thing collapsed. By 2022, only 86 SPACs launched, and companies that merged during the peak lost an average of 67% of their value. It's a tale as old as time. When the market is booming, insiders sell. When it drops, the IPOs mysteriously vanish, leaving regular folks trapped.
Now, what's really interesting about this is how we can take all of this historical precedent, the dot-com crash, the 2007 crisis, the SPAC bust, and apply it directly to the present day.
We are currently watching fierce tech rivals, companies that agree on absolutely nothing, all racing to sell you their stock at the exact same moment. Why? Why are the insiders of the artificial intelligence boom sprinting for the exit right now? Well, the source argues that it all comes down to two very specific numbers. Here is the first number, and it is absolutely staggering: $725 billion. This year alone, the largest technology companies on Earth are on track to spend $725 billion just building out AI infrastructure. That is a massive 77% jump from just the year before. We are quite literally witnessing the largest and fastest infrastructure build-out in the history of humanity. To really wrap our heads around the sheer scale of that spending, the source uses this incredibly vivid historical analogy. Imagine spending $1 million every single day. If you started doing that on the day Jesus was born, and you kept spending $1 million every day through the Roman Empire, the Middle Ages, both world wars, all the way right up to this very second, you still would not have spent as much money as big tech plans to spend on AI in the year 2026 alone. When you break it down, that is roughly $23,000 being spent every single second. Crazy, right? And this brilliantly illustrates the second number, the one nobody seems to be talking about. The research firm Exponential View did a bottoms-up estimate of the entire AI economy. While big tech is spending that mind-blowing $725 billion, the entire AI industry combined only generated an estimated $110 billion in revenue over the last 12 months. And remember, that's not profit, that is just revenue. The entire AI economy is only earning back about 15% of what's actually being spent. By traditional financial metrics, that is an incredibly dangerous gap. But wait, surely the companies actually using all this new AI tech are seeing the benefits, right? Well, the data actually says otherwise. A massive Deloitte survey looked at 3,000 business and IT leaders across 24 different countries. They found that while 74% of them desperately want AI to boost their revenue, the reality is super different. Only a tiny 20% slice actually saw that happen. And honestly, if that wasn't concerning enough, a study by researchers over at MIT really hammered home these deficits even further. They looked at hundreds of real-world corporate AI rollouts. We're talking actual businesses spending real money to implement this technology right now. And they found that a staggering 95% of these rollouts produced absolutely zero measurable return on investment. Basically, nothing to show for it. The source uses OpenAI as the prime example of this massive disconnect between perception and reality. Because their financials leaked, we can actually see the picture crystal clear. Last year, OpenAI brought in a really impressive $13 billion in revenue. But you gotta look at the other side of the ledger. For 2025, they are projecting a massive net loss of $38.5 billion. Internally, they expect to burn through well over $100 billion between now and 2029.
And yet, despite those totally horrible fundamentals and those massive projected burns, the market is pricing these companies as if the gap between spending and revenue doesn't even exist. In its last funding round, OpenAI was valued at $852 billion. Let that sink in. That is more than 65 times its revenue. These aren't valuations based on current financial realities anymore. These are bets fueled entirely by blind, euphoric optimism. Which brings to mind one of the most infamous quotes in the history of modern finance. Back in the summer of 2007, just months before the entire global financial system nearly melted down, the CEO of Citigroup, Charles Prince, was asked about all their risky lending. And he said, "As long as the music is playing, you've got to get up and dance." See, he wasn't saying the party would last forever. He knew for sure it wouldn't. He was saying that as long as the money is flowing, insiders basically have to keep participating, knowing full well that whoever is left on the floor when the music finally stops is going to be the one who loses everything. Ultimately, the source concludes that what we're watching right now is essentially a high-stakes, multi-billion-dollar game of hot potato. The insiders aren't dumb. They can clearly see that stock prices have sprinted miles and miles ahead of actual financial fundamentals. They know a massive disappointment could be looming right around the corner, so the only rational move for them is to pass that hot potato, their highly overvalued AI stock, onto the most enthusiastic crowd they can possibly find, everyday retail investors in the public markets. Because, you know what? The fundamentals always catch up eventually. Now, the source fully admits no one has a magic stopwatch to predict exactly when this bubble might pop. It could be a month, a year, or even 3 years from now. But you don't really need to know the exact date. You just need to be able to read the room. So as we wrap up this explainer, I'm going to leave you with this final provocative thought to consider for your own investment strategies. When you look at the AI market today, are you reading the room, or will you be the last one left on the dance floor holding the bag?